Alright guys, so the implosion has begun. People are selling their office buildings for a grand sum of $1. And if this doesn't spell a crisis in commercial real estate, nothing will. You stack this up with major economies in the world entering a recession. Germany, Japan, and the UK, it's not a good sign. This CRE crash is a symptom of the economy starting to break under the weight of higher interest rates, and it's about to get much worse. Office tower deal for $1 reveals anxiety amongst long-time buyers. Canada's largest pension fund just did a fire sale. They were losing a ton of money and they had enough. Investors finally realized the truth that rates are going to stay higher for longer. Rentals are going to drop and the value of my commercial property is going to collapse as well. So there's very little point in hanging on. And that's why we are seeing insane $1 deals for entire office building. That's just insane. And when we dig into the details, you'll see just how desperate things are. The fund sold their interest in a pair of Vancouver towers, a business park in California, and an office tower in Manhattan that went for $1. And these are all commercial properties, especially in the office space. We've been saying this for over a year now. People are no longer coming back to the office, so rentals are going to keep collapsing, which is destroying this investment class. And the situation is truly terrible. Vacancy rates across the US were at nearly 20% in Q4 last year. That's higher than the levels in over 40 years. These are just the national averages. There are some areas where vacancy rates are 30 to 40%, like San Francisco. And remember what vacancy rates really mean. It represents a loss of income to the property owner. Throwing a discount to tenants just doesn't work anymore. It just creates a snowball effect where future leases will have to drop as well. In other words, the owners, they are trapped. And here's how desperate things are. The pension fund sold their 29% stake for $1. But here's the critical part. The sale entails the buyer, Boston Properties, to assume the remaining debt. It's basically a transference of obligations. The fund expects prices to keep crashing and the income stream to dry up even further. And they are bailing out. They have folded their cards and they are running away. They already spent $71 million on the project, but they are selling the whole thing for $1 to escape an additional $46 million payment. And this sounds crazy, right? It's a 60% discount to the new buyer. I know what you're thinking. Make it make sense. Well, it's very simple. The pension fund believes they will lose more than $71 million on this, and they have no idea how long this chaos will last. They expect interest rates to stay high, the loan repayments will come due every single month as well. At the same time, the value of the office tower will keep crashing down. In other words, the pension fund will be deep in the red if they don't exit now. And this is only going to be the start. We'll see even more fire sales down the road, and it's going to affect not just the investors but the banks themselves. And this could very well be the trigger for a US recession. Now, what's truly disturbing is pension funds getting to commercial real estate. Understand the purpose of a pension fund is to protect and grow the wealth of old people, the elderly. They should be buying conservative investments that guarantee income without horrific losses. But nope, they decided to buy into commercial real estate. It kind of makes you wonder who sold them the idea. Probably Wall Street. The Canadian fund, for example, has a total pool of $590 billion, of which 41 billion belongs to real estate investments. That's around 7% of the fund, which is a very significant amount. And it's not just them in trouble, there are tons of pension managers with exposure to CREs. It's really mind-boggling if you look at the numbers. If we just analyze the exposure in US pension funds in real estate, we can see something really scary. The top three investments are commercial real estate, multifamily homes, offices, and industrial buildings. All these are considered CRE. There are 12 billion in multifamilies, 10 billion in office spaces, and $9 billion in industrial real estate. And this is the problem with all these investment funds. They are busy chasing yields, forgetting the basics of commercial real estate. CRE goes beyond just a rental. It's much riskier than government bonds, which is bad enough. At least with a US Treasury, a government bond, say a 5-year note, you hold it to maturity, you still get back your capital at par value. Sure, you lose to inflation, but at least you still get back the principal. But commercial property is a whole different matter. If interest rates stay high and rentals go down, you could be losing money month after month. In other words, you could be stuck with a negative yield investment. And when it comes time to sell the office building, it could be worth far less than what you paid for, maybe 50%, maybe 70%, maybe 80% down. It's a complete disaster that's sweeping across pension funds. Large pension funds, REITs, and insurance companies are on the hook collectively. They hold more than $1.2 trillion or 22% of the entire CRE debt burden. This $1 fire sale tells us the level of desperation. The cash flow for office buildings just doesn't make sense. It might never recover for a long, long, long time. And this next chart tells us that the CRE collapse probably isn't over yet. In fact, it's going to continue for many more months. Building occupancies in the US and Canada have stagnated. They're at 50% of the pre-pandemic levels, much lower than other parts of the world. Lesser tenants means fewer rents to collect while your debt payments are going up. You are bleeding money month after month. You are cash flow negative. You are financially screwed. And as we move towards a global recession, layoffs are going to come. We are seeing it all over the headlines, right? 1,000 jobs here, 10,000 jobs there. Do you think more or fewer people will be renting office space? You don't have to be a genius to figure this out. And there's already a mountain of evidence that shows that CREs are collapsing. Brokers are busy trying to offload office loans at 50% discount. There's a fire sale that signals Armageddon for commercial properties. But can this get any worse? And this is where things get quite simple. It's not complicated to project how bad this disaster can get, and it's all tied to interest rates and the Federal Reserve. The longer Fed fund stays at 5.5%, the more implosions we'll see. And for Powell, the main metric he cares about is inflation. And this is where the bad news keeps mounting up. A key Fed inflation measure, the PCE, has risen by 0.4% in January, up by 2.8% from a year ago. Inflation is now entrenched and services are making prices stay high. Inflation is now back to the levels in January 2023, which is a serious problem. This sudden jump should be very concerning. So the Fed has the perfect cover to delay their rate cuts. It's definitely not coming in March this month. People are saying that the first cut will come in June, but will it really? We have a lot of statements coming from the Federal Reserve that even June might be too early. Remember, all these Fed governors, they are just mouthpieces for Jerome Powell. He can't say the truth directly, so he gets his minions to guide the markets. And I want us to pay attention to two particular voting members of the Federal Reserve. That rate cuts might be delayed for much longer than we think. According to Bowman, the time for rate cuts is certainly not here. The Fed's policy rate is in the right place. In other words, inflation is just too high. They are losing the inflation fight. There's still a big supply side problem going on. The Atlanta Fed also gives us a more realistic timeline. Expect the first rate cut to be in Q3. But if inflation continues to progress, rate cuts will be delayed. So the first cut might be coming in July to September. But if inflation stays strong, the Federal Reserve won't take action until October Q4. And if this prophecy comes true, we can expect a total collapse of commercial real estate. Prices are already starting to crash big across the US. Prices in San Francisco are down by 40%, Manhattan has crashed by 15%, and Boston is down by 13%. The longer rates stay high, we can expect prices to keep dropping, and this will unleash a daily cycle of investors and owners dumping their buildings to avoid those monthly payments, and that in turn drives prices down even lower. But let's talk a bit about the banks. This is where things get from bad to worse. Pension funds hurting is just one thing, but if the banks themselves collapse from CRE, this will affect the entire economy. We could see credit drying up and loans across the board will either stop or get really, really expensive. And you mix this up with high inflation. This is a big recipe for a recession in the US. America is not 100% immune to this. Banks today are the most exposed to CRE debt. A lot of loans are going to mature for the next 4 years. This year and next year alone, there are over $1 trillion worth of property loans maturing, most of which nearly 600 billion of debt belongs to the banks. If property owners continue to default, the banks will take the biggest hit. If you're a bank today, you are caught. If a developer comes to you for refinancing, you can't say no, but you can't say yes either. If you refinance it at higher rates, the odds of a default down the road becomes higher. But if you don't, the owner might instantly default today. So you either take the hit now or prolong the agony, which could make things even worse. It's a really big issue and it's shocking that mainstream media isn't covering this enough. The headlines are simply ridiculous. It's either Nvidia going to the moon, the S&P at 5,000 points, or China is collapsing tomorrow. You don't hear much about CRE, and here's why you absolutely must. The amount of distressed loans is staggering. Over $320 billion of property are under distress, and a quarter of those are in crisis mode. This means outright bankruptcy and defaults. the banks here are directly screwed. The remaining 230 billion of loans are in potential distress. That includes delinquent payments, forbearances, and leasing problems, which means the banks are about to be screwed soon. Over the next few months, we can expect more of this to convert into direct defaults. It's not very complex, it's a direct result of interest rates staying too high for too long. Remember NYCB Bank? Well, the pain from CRE loans is destroying them. The stock price of the bank has collapsed again after discovering risks on their loan books. The first drop came from the market discovering that the bank set aside a ton of money to cover for their CRE losses. The next crash came when they realized that the bank had a big oversight when writing loans, and this begs the question, how many more banks are in silent trouble? How bad are their books really? If the banks collapse, so does the US economy as well. They are all joined at the hip. So this crisis extends beyond just the smaller regionals. If CRE crashes further, the big boys will be impacted as well. There is no escape here. From the FT, bad property debt exceeds reserves at largest US banks, and these aren't small players that are at risk. We are talking about the biggest banks on Wall Street that could take a bad hit as well. And here's the problem the banks face. The value of delinquent loans more than doubled last year to $24 billion. However, the banks only hold $1.40 for every $1 of delinquent CRE loans. The safety buffer is starting to shrink, which is a big problem. If the collapse gets worse, this buffer will start to disappear fast. If this gets severe enough, that could hit the balance sheet of the banks. It will hammer into their earnings and their profits. We can see the CRE coverage across all the big banks drop in 2023. Citigroup, for example, has only 50 cents to $1 of delinquent loans. Only Goldman increased their reserves to buffer against a crash. The biggest drop in coverage comes from BOA, but across the board, they are all exposed, maybe except for JP Morgan. And this is not a good situation. I'm not saying that the banks will collapse. What I'm saying is that their earnings will get hit and their stock prices will drop if delinquencies increase. And if the big banks suffer, that spells doom and gloom for the economy. Credit will get tougher to get and lending standards will tighten once again. So this crisis is a systemic one. It's not just about office buildings being sold for a dollar. It's something much more sinister. And this could very well be the trigger for a US recession. But let me know what you think. Is commercial real estate the trigger? And how bad will this get? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.